Welcome. My name is James Barber. I'm your Oregon Cash Flow Pro. What's that? Why, yes, I did get a haircut. Thank you for noticing. Time to get serious. This is going to be a response video. I don't like to do these, but when I see something as egregious as what I just watched, I have to say something. I can't let this sit out there where potential clients might see this and not realize what is going on with this type of a video. What is the counter argument to what's being made? And it's more than just a counter argument. There are things going on in this that really bothered me. Now, this is probably going to be a fairly long video because I'm going to get into the details on this. This will probably be a definitive video on policy design for IULs, but YouTube probably won't like that as a title, so I'll probably title it something different. And fundamentally, most of the time, what it comes down to when we're talking a good design compared to a bad design in an IUL, it's going to boil down to the expenses inside of it and how commissions dictate how big those expenses are for a long time. I don't have any problem with commissions. Good salespeople earn their commissions. Sometimes things don't happen without somebody getting a commission. So I'm not here to say all commissions are bad and because somebody is charging a higher commission that they're bad. Not at all. There are different business models out there. Some business models are targeted to reduce expenses as low as possible. And presumably, if they're going to be a successful business, they're going to make up for that in volume. Other businesses choose to be in a niche where maybe they provide greater service. Maybe they provide some supplementary services to go along with whatever it is that you're buying. Some way to build value so that if you are paying a higher commission, it's worth it. That's okay. I'm okay with that. I'm not going to take my time to make a video to call somebody out just because they run a different business model and they want to provide something different to a client. I don't have any issues with that. But what I don't like is the FUD. The use of fear, uncertainty, and doubt is a sales tactic to obfuscate the real goal, which is to make more money. Now, if you want to charge higher commissions, do it. Stand behind it, justify it. But don't fool your clients into thinking that they're getting a better product or they're paying more for something for other reasons than that. This video is going to get a little bit detailed. We're going to get into the numbers. I'm going to show you a bunch of different things. You can always just skip to the end if you want to see the ultimate result of what these numbers do. But I think there's a lot of value that you're going to find if we go through this video step by step. So let's get it started.
The company is not just doing that because they love you. I hate to break it to you, but that's not how it works, right? They are not waiving surrender charges because you're a great person. They're waiving surrender charges because you added a rider for a fee. We've been doing this for a long time, tons of policy reviews specializing in index universal life insurance, whole life, and really any form of cash value life insurance. And a lot of the requests that we get is, I'm looking for high early cash value, as high as it can possibly be. I want to put in, $100,000 and I want to have $100,000 accessible to me. We've heard it all the way up to, millions. I want to put in $500 a month and have 500 there. Okay. There's all kinds of ways that you can show high early cash value. And today I'm going to show you why typically we talk people out of high early cash value. So first what I'm going to do is
Okay, let me start off by saying there are reasons to talk somebody out of a high early cash value design because a lot of high early cash value designs, the agent is using a mechanism that will create higher early cash value at an additional cost to the client. That part's valid. I don't have any issues with that. Let's continue.
Show you a high early cash value design from a current policy, like a current illustration that someone might use to show you, hey, you can have high early cash value and it looks really good. This is what you should get. And then I'm going to show you from an in-force ledger. I've taken screenshots from an in-force ledger on a high early cash value policy. It's not one that we wrote. Someone sent it to us because they needed help with it. And I'm going to show you why on paper, a lot of times those high early cash value products don't work the way that they're supposed to work. So I'll share my screen and we'll go through all this one bit at a time. So here's our high early cash value design. And on the face of it, it looks pretty darn good. It doesn't matter what company this is with, because every single company is going to essentially, you're going to have to make the same tweaks to end up here. So we're putting in $200,000 over 5 years, total of $1 million in the policy. And we're breaking even. I mean, essentially we're breaking even here in year 2, 394, really breaking even by year 3, 612 in cash value. You put in 600. By the end of the 5 years, you got $1,093,000. You'll notice there's no surrender charges on this particular policy. That is one of the tricks to get those high early cash values. Most of these policies, if not every single one, is going to have, unless it's a high early cash value specific product, all these policies are going to have surrender charges. And that is one of the reasons that you'll see your premium outlay to cash surrender value in that first year off by quite a bit. And that's okay. Those are surrender charges. There's no such thing as a free lunch, okay? If we waive the surrender charges, the company is not just doing that because they love you. I hate to break it to you, but that's not how it works, right? They are not waiving surrender charges because you're a great person. They're waiving surrender charges because you added a rider. Typically, it's called like a surrender value enhancement rider or a waiver of surrender charges rider or whatever. There's all kinds of names for it. It doesn't matter. They all do the same thing. They waive the surrender charges for a fee, okay? For a different fee. So just hang on to that. We'll get there in a second. The other thing that I had to do with this policy is a huge term insurance blend in order to get that cash value higher. We'll talk about that as well. And then the last thing I needed to do is the way that the IRS is going to look at this policy, rather the way that the company is going to look at this policy and determine whether or not they report distributions to the IRS, is whether or not this policy is considered a modified endowment contract. And there are rules around what makes this policy a modified endowment contract. And if you want all the dollars coming out to be non-reportable, you do not want this to be a MEC, a modified endowment contract. Okay, well, the IRS basically has two ways they test these policies to see if it's a modified endowment contract. One is called the cash value accumulation test. The other is called the guideline premium test. And whoever you're working with, the broker or you, if you know what you're doing, you get to choose which of those two tests you use to determine if this policy is a MEC or not, and thus taxable. Cash value accumulation test is the only thing that whole life can use. They can't use the guideline premium test. The index life world can use either. So you get to choose in the index life world. In whole life, you have to use cash value accumulation test. The cash value accumulation test typically is going to allow you to have higher early cash values, but it's going to require you to buy more insurance later on in the policy life. So you can see high early cash values, but the costs ratchet up much more quickly than it would in the guideline premium test, because as you get older, they actually require you to buy more insurance. That makes it more costly. Well, in order for this to have such a high early cash value, 190 versus we put in 200, I had to use that cash value accumulation test.
Okay, so let's step in here for just a second. I let that play for quite a bit. I don't have a problem with most of what he just went over. Most of that is good. I need our viewers to understand the power of YouTube. The power of YouTube and the power of YouTube for marketing purposes. This guy makes some great videos. They're very informative. He goes into quite a bit of detail. He does a really good job of explaining most of the things. The thing with YouTube people, the content creators, they're also called influencers. The reason they're called influencers is because of the influence that they have over the people that watch their shows. You may have realized this, you may not have. The more time that you spend watching somebody, the more likely you are going to trust what they're telling you. And you might not question it unless you have a reason to question it. And this is part of where I have a problem with some of these videos, is because you'll get somebody like this who's very good, very detailed. When he says all of this stuff, sounds really good because it's mostly true. But then there's going to be some things that get inserted that might not be true, or they might twist things in order for them to influence you to make certain decisions. This is what you have to be careful with. You are most likely not an expert on index universal life insurance. That's why you're on YouTube. That's why you're watching these videos. And you assume that you're going to hear the truth from the people that you're listening to. Now, if you watch my videos, you do get the truth. And I back it up and I show all the numbers. And we're going to do that in this video. We're also going to point out where the video that we're looking at, the one we're reviewing here, he doesn't do that. He makes a lot of statements, but he doesn't back it up. I'll get more into that later. But just know that you got to be careful with who you give your time to on YouTube, on any social media platform, whoever you're listening to. Be careful who you give your time to, because the more time you spend with them, the more likely you are to trust what they're saying. Make sure that they've earned that trust. Get some information from some other people who may know and have insight into this stuff. It's okay to have different opinions, but it's when the facts get skewed. That's when we got to really start to wonder what's going on. And anytime we're dealing with products, sales products, where we're going to earn a commission, you got to be extra careful. You go buy a car at a dealership, you're not just going to take their word for it, that they're giving you the best deal. People have learned over time, you can't trust car salesmen to give you the best deal. You have to drag it out of them. They may act like your best friend, but you're not going to get the best deal unless you go in there with the proper information and you demand it. So just be careful who you trust. Hopefully this video will help you identify, at least in the IUL space, some things to watch out for. He mentioned having to use the cash value accumulation test with this particular design in order to get high cash value. That's not true. You don't have to use a cash value accumulation test to get high cash value. There is an enhanced liquidity rider in this. I know which product he's illustrating here. I own this product. He mentioned earlier this is a current product. This is not a current product. This video came out 1 day ago. This product hasn't been available for about 6 months, maybe even a little longer than that. Now, if this product was still available, I would be able to match this illustration. I can't do that, but I got close. We used the new product, the one that replaced this. It has some different charges, but we're going to be able to explain everything as if we were able to recreate this one first. He mentioned a modified endowment contract and how you don't want a modified endowment contract. When I went to recreate this illustration, I saw this little symbol next to policy year 1. And I went, I'm not familiar with that symbol. I don't see that symbol on the illustrations that I design. What does that mean? Look at the top of the screen here. That's what it means. He's illustrating a modified endowment contract. This policy that he's showing you is a modified endowment contract in year 1. As I was trying to illustrate this, I could not use a $2.5 million death benefit and get $200,000 in year 1. The only way I was able to do it was by allowing it to create a modified endowment contract. So I thought that was kind of funny. And he said this is one that he designed. Now I imagine he may have just pulled this off the shelf because he certainly didn't do this illustration recently. So he must have pulled this off the shelf and he could just be talking about this, trying to recall what he did. And he didn't remember that it became a modified endowment contract, but just recognize that's what we're dealing with here. It doesn't really affect the early cash value. The only difference a modified endowment contract has is you can put more money in with a lower death benefit. And because of that lower death benefit, it might create more cash value. But you don't have to create a modified endowment contract and you don't have to use the cash value accumulation test. Almost all of the designs that we do not use the cash value accumulation test. And we get lots of high cash value even without using the enhanced liquidity riders. Let's move on with this.
Those are some of the tricks of the trade. I can make a policy look good on paper, high early cash value. And this policy does look good on paper. You put in $1 million, you double your money in 15 years in a fixed product that's going to come out tax-free. That's not too bad. Like that's pretty good. But there are some huge holes with this particular design, and I'm going to show you exactly what they are. In order for you to see exactly what I'm talking about, all we have to do is look at the charges ledger. So here is the charges ledger. And anytime we talk about life insurance specifically and the charges, a lot of people talk about the differences between whole life, index life, variable life, current assumption UL. And there are definitely differences. We've done videos on that. If you want to see it, I'd encourage you to check those out. But when it comes to this particular topic, it's super important to understand that not all fees are created equal. not all fees are created equal. Some of the fees in the indexed world, and the reason we're going to talk about the indexed world is because you don't actually get to see the fees on whole life. You've never seen a fee ledger on whole life. You just haven't. You haven't seen the fee breakdown because it doesn't exist. The only person that sees those are the actuaries. Your broker does.
That's true. That's true. These are some of the truthful nuggets that he's inserting into here that is actually dead on. You don't get to see the expenses in a whole life.
Doesn't see those. The agent doesn't see those. The person at the home office that you call, the 800 number, they don't see those. The actuary knows the fees. They're the ones who build the product. But in whole life, they do not disclose the fees. Okay, so that's why we're looking at index life. They do disclose the fees. We know exactly what they are, and we can see the different line items. Not all of these fees are created equal. We have a premium charge, a per unit charge, and a cost of insurance charge. Now, the premium charge and the per unit charge are generally speaking fixed. They're going to be fixed the moment that you purchase the policy. You're going to know what those are because it's just a straight premium load. Every time you pay a premium, a certain percentage comes off the top. And then the per unit charge is just a flat fee based on your starting death benefit. That is relatively standard across all companies.
Okay, so this is part of where the misinformation comes in. Let's back up just a little bit. The per unit charge is fixed once you buy the policy, but it is not fixed based on your total death benefit. The amount that you pay in that column is based on the death benefit, but it varies depending on how that death benefit came to be. If it's a mix of that blended term insurance that he mentioned earlier, you get a much lower per unit charge than if you didn't blend it in. So it's a little bit misleading to paint this as if the premium charge doesn't change and the per unit charge doesn't change. That's basically what he makes it sound like here. Don't worry about these two. Let's talk about these over here. Meanwhile, he's not going to be showing you his design and what the expenses look like in this particular video. But there's a couple of interesting things to note. This is the per unit charge on the policy that was designed, that's a mech, but he mentioned earlier it was a blended term design, which actually reduced this quite a bit, way lower than if he didn't use that blended term design. In the design, when he added the enhanced liquidity rider, it does not increase the per unit charge. It increases the rider charges because it's a rider that you're adding to the policy. There's one other thing to note, and that's this premium charge. When I went to recreate this, I know this product. This product charges you an 8% load fee. That's a one-time charge to put money into the policy. And when you don't put any money in, there's no load fee. That's why we see zeros down here. But this is not 8%. This is more than 8%. It was this that actually led me to realize that, oh yeah, we're dealing with a modified endowment contract. Because in this particular product, if you fund above the MEC limit, they charge you 14% for a load fee on the amount that's above the MEC limit. Well, the MEC limit at 2.5 million is less than 200,000. So the reason that this is more than an 8% total load fee is because there's some 14% load fee charges blended in with this. But he's not going to mention that here. It's kind of not pertinent to his argument in the video, so I don't blame him for not mentioning that, but I thought it was interesting when I recreated this policy, how badly this policy was designed. I don't know why he created it in the first place. Like I said, he must have pulled it off the shelf. He didn't create it for this particular video, but he's using it in this video, so I wanted to talk about it. There's just some interesting things that goes on, because there are other carriers that do the same thing, where they will charge you a higher load fee if you max fund that policy. There's a carrier that will charge you a massive load fee, even if it's not above the modified endowment contract. They'll charge you a huge load fee, even if it's just above target premium that you send in money. That one's a terrible product, in my opinion. It's not this one, but you gotta be careful about these things out there. This is the load fee. You can see where they're charging the 14%. I put this up here because you guys don't need to just take my word for it. I'm showing you how I came up with this stuff. And we're gonna go over the designs, all the designs that I put together. I put together a design that basically matched this, but with the new product. I did a design that would be how I've seen his company design. I did a really good design, and then I did a really terrible, terrible design, even worse than what they do. So I'm going to share all those later on in this video, so stick around. But I think it's important that we don't just tell you and you trust us as a YouTube influencer or a YouTube content creator. You should trust us because we're showing you the details.
They don't really change. Okay, they are what they are. Where most people get hung up is in this cost of insurance column. Now this looks like a sexy chart. Our cost of insurance, we only pay cost of insurance in year 1 and 2, but only $287. You're telling me that we only pay cost of insurance for 2 years? We're paying $1 million into this policy and we're paying less than $1,000 total for the insurance costs? Like, that looks great. Sign me up. This is the cheapest policy you can possibly buy. Let's go. Let's go. Well, yes, that is the way that it looks. However, there's a huge problem with this. And what I'm about to tell you is that this is not the trade-off that you want to make. You do not want to see $0 in cost of insurance. What? Right. You do not want to see $0 in cost of insurance, because if it's not here, it's going to show up somewhere else. Are you not buying insurance? No, of course you are. Well, where are the fees associated with the insurance? They're not housed here in the cost of insurance line item. They're actually housed in the rider charges. So you've essentially traded a cost of insurance for a rider charge in every single year. That is a huge deal. The rider charges are essentially made up of 2 line items. Number 1 is the surrender value waiver. Remember, we waived surrender charges to get that high early cash value. The second makeup of the rider charges is the term insurance rider. We put a bunch of term insurance into this contract to make it a little bit cheaper and see a higher cash value. Sometimes that's totally fine. There's nothing wrong with doing that. But in this design,
Actually made it a lot cheaper to do that blended term insurance design. And I would say it is very important, but not for the reasons that he's doing it. He makes it sound like it's very important, look out, instead of it's very important because the overall success of your policy may depend on having the expenses be very, very low.
it's an issue because we have no cost of insurance. And here's what you need to know about these 2 line items: cost of insurance and rider charges. The cost of insurance is exceptionally difficult to change, okay? It can change. Companies can change their cost of insurance, but in order to change their cost of insurance, they have to prove what's called adverse mortality. What that means is they followed all the rules. They built the house to code, okay? They didn't cut any corners. They did everything they were supposed to do, but they happened to experience abnormal losses, abnormal death rates. They insured all the people that got hit by a bus that year. They have to prove adverse mortality to their state insurance commissioner, who is an elected official, okay? They have to prove adverse mortality to a politician who then has to allow a fee increase on his own constituents. Okay, so let me say that again. They have to get a politician to essentially approve like a tax increase, air quotes, right? It's not a tax increase, it's a premium increase on their own constituents. That hardly ever happens. Hardly ever. It's happened, I think, 3 times. I might be wrong on that, 3, 4 times tops. Every time it's happened, it's been a B-rated company, I believe. And typically through the process of a sale, a book of business gets sold, it's unprofitable, they have to raise fees in order to keep the block of business intact. Okay, well, that's a little bit different story here. You cannot just raise your cost of insurance. It is a process, it is difficult, and there's a maximum allowable increase on cost of insurance.
Okay, so, wow, that was a powerful moment in that video. I bet he's pretty proud of that. Let's assume it's true. It could be true. Maybe they do have to do all of that. It doesn't indicate it in the contract. Our actual contracts have language in them. The insurance company's contract, this policy, the specific contract language in this policy, which I'm going to show you. This is my policy. It's the same product as that one. This is the actual language. It tells you how they calculate the insurance charge. The monthly cost of insurance rate for the guaranteed insurance cost charge is equal to the applicable rate in the table. There's a table earlier on in this that gives us the maximum amounts. And here's a few pages down where it talks about rate changes. Any rate changes we make will apply to insureds in the same class. If we make any rate changes, they will be based on future expectations of experience factors and any factors contributing to those experience factors as described herein. Any changes we make to monthly cost of insurance rates, rider charges, expense charges, interest rates, participation rates. This is basically all of the things that can change inside of the policy. Any changes they make are going to be based on future expectations of policyholder experience, mix of business, investment experience, policy values, pricing methodology, accounting standards, reserve standards, tax and regulatory law, expense experience, morbidity experience, and mortality experience. Now, that includes a lot of the stuff that he just mentioned. And in general, insurance companies are required to get approval for different rates. Certainly when it comes to what they charge for health insurance, all of those things apply. When it comes to long-term care insurance, all of those things apply. You have numbers inside these contracts, though, that they say that they can charge you up to a maximum of. I don't know if the insurance company is not able to make changes to the base amount. It might be true, or it might just be a good argument, trying to justify why you would want to see more in that cost of insurance column as opposed to the rider charges column. If an actuary out there knows, I would love to hear from you in the comment section. If that is actually the case and there is a difference between the cost of insurance and the supplemental term. I asked some of the folks from this carrier, what's the difference with the supplemental term and the regular term? And they said there was no difference. One pays a commission, one doesn't pay a commission. The reason I asked was because inside the illustration software, we have the opportunity to convert. If I design this with supplemental term, there's 10 years that I can convert it to regular base face amount. And I said, why would I want to do that? What would be the situation that I would want to do that? And there wasn't a good explanation. If I do show the conversion, it adds cost to the policy. The client gets charged for the conversion. Maybe it kicks out an additional commission every time it converts. I don't know. But for some reason, they're charging more every time you do it. That was why I asked. Why do we do that? What would be a situation where I would want to do that? I didn't get a good answer. Back to the video.
Rider charges are totally different. A rider charge on almost every life insurance policy can be changed at any time for any reason in any amount. Now, I'm overstating that because some companies might have guardrails on their rider charges. Most do not. And maybe they have a guardrail on one rider, but not another. The bottom line is this. You do not want to shift your fees from a protected fee, cost of insurance, to an unprotected fee, rider charges. When you do that, you set yourself up to essentially give all of the power over to the insurance company to have total control over the fees that you pay on this policy outside of the 3 that are fixed. Well, 4, the policy fees fixed. So you got fixed fees here for the most part, fixed fees. And then you have an unfixed, no guardrails, no cost controls, can change at any time for any reason in any amount. They just send you a notice and you got to pay it. You do not want to make that trade-off. That is
Wow. Oh my goodness. Did that scare you? It sounded like it was designed to scare you, or somebody might say create some fear, uncertainty, and doubt about using the supplemental term rider that puts that cost in the rider charges column. Now it's funny that he's using this particular company. And I find that funny because let's see what it says in the contract. The initial charge is shown. We can change the monthly COI rate at any time, but it will never be greater than the guaranteed monthly cost of insurance rate. So this one actually does have guardrails, and we can actually go look at what that amount is, and it'll tell us. Now, you don't have to have a contract to be able to kind of figure out what those are. We can kind of figure it out from an illustration, and I'm going to show you this later when I start to show you the illustrations that I did based on his video. But when you look at the guaranteed part of an illustration, it assumes maximum charges. Any charge in the policy, it's going to be listed at the maximum amount. So if you look at that guaranteed column, you're going to see what the maximum cost of that insurance could be. And you can see here, they have a current charge that you find in the current values on an illustration, and they have a maximum charge. That's part of the guaranteed value of the illustration. So this particular video, he really wants you to be afraid of that insurance in the rider column. The product he's using does have guardrails. In fact, I would be surprised if any of the carriers did not have guardrails, because all of the carriers are required to provide a guaranteed part of their illustration. And the only way you calculate that guaranteed part of the illustration is by putting maximum charges on it. How do they determine the maximum charges if it's not specified in the contract? Maybe he has an answer to that. We're not going to hear it in this video.
Incredibly risky trade-off to make for the purpose of just having higher cash value in those early years, because you're going to pay for it over the long run. Now, look.
Okay, it's a risky trade-off, he says. It's a risky trade-off. Is it? What's the risky trade-off that we're making? Just the risk that the cost of insurance could change? All right, well, let's see what that risk might be. Are you going to show us? Are you going to show us any examples in this video? Let's find out.
If you see this video and you think, I don't care, I want high early cash value, then great, go get it. But it would be wrong of me to say, yeah, there's nothing wrong with doing this. It's totally fine. It's just like anything else. There's really no risk. You just want more cash early? Yeah, we can do that. No questions asked. Let's go.
Okay, another thing that frustrated me about this video is the framing of it. He constantly makes the reference to high early cash value. The only reason you might do a design that has blended supplemental term insurance is for high early cash value design. And you don't really need high early cash value design, because what do you give up later on? But he's not showing us an illustration that he designs that has lower early cash value, so that maybe we can look and compare what happens later on in the policy. I'll tell you what, the reason I like to see high early cash value in a properly designed policy is because it leads to a lot more high cash value later on in the policy. It's not just high early cash value that's important to us. It's high cash value, period. And we could get hundreds of thousands of more dollars into a policy that has reduced expenses in the beginning because we get greater growth and compounding. And I'm going to show you that in a little bit. But he doesn't show us in here. He has not shown us an alternative in here.
But that's what most people out there are doing. And we get so many policies that come through our doors or that get sent to us where they had high early cash value, something like this, 200 in, they got 190 or so in cash, and they're 4, 5, 6, 7 years down the road. And all of a sudden, none of the projections look even remotely close to what they were initially shown. And I'm going to show you one of those policies right now. So I want to highlight.
Did the projections not pan out because they increased the cost of the insurance in the rider column? Maybe he'll answer that question. Let's find out.
What was done here. So here's just an input summary. How was the coverage determined? Well, our death benefit option was level. And if you know anything, if you've been watching this channel and you've been following us for the last, 7 or 8 years, you know that right there is a dead giveaway that something might be wrong. Level death benefit, something's wrong here.
Okay, I'll just let you know, this is not the same product that he was illustrating just a little bit ago. He kind of mentioned it. This is an older product that he got. And presumably, he's showing us this because something changed. Something changed inside of it.
Decrease the amount when we can. This is a lowering of the death benefit. Did not select that. Okay, so the death benefit stays high. That's another issue.
So this policy is clearly not designed well. We don't generally use a level death benefit. We get higher MEC limits if we're using the guideline premium test, and we use an increasing death benefit to go with it. And we generally want to show a switch to go from increasing to level later on in the policy. Now, this started out as level, so there's no reason to have a switch. It doesn't look like they're illustrating a reduction in death benefit either at any point, which if you're just funding for a short period of time, you're probably going to want to do that.
Here's our testing type, our DEFRA type, our MEC testing, cash value accumulation test. Okay, so we know that this policy is going to be more expensive in the later years. That's also a red flag. It has the surrender value enhancement agreement. So surrender charges have been waived. And for that waiving of surrender charges, the fees on this policy have been increased for the life of the contract. Okay, so
maybe, I don't know this particular policy, but in the carrier with a product that he did before, it only increases it during the surrender charge period. You pay for that enhanced liquidity rider for 12 years when it would normally have a surrender charge. So maybe it's different with this one, but you're not necessarily paying for it throughout the life of the policy unless you think about it as opportunity cost, because that is money that you miss out on that early compounding because you had higher expenses.
So far, what do we have? We have a level death benefit. Nope. Need an increasing death benefit if we want maximum cash. We don't have any term blending on this particular contract. There should be some term blending. Too much term blending can get you in trouble because, again, you're trading cost of insurance for a rider charge. There is a sweet spot where you can make it work. None of it's being done here. They're not decreasing the death benefit.
Oh, so he is advocating for some blend. That's interesting. I wonder how he determines how much risk is too much risk when it comes to the term blend. Or in general, how I like to look at those is like, how much commission do you need to build in for your particular business model? If you do that design because you need to make that much commission to sustain your business model, then that's fine. Do it. But don't frame it as if you're doing it for your client's best benefit, unless that benefit is they get to work with you because of that design. Because that's really the only benefit to paying that higher design. As you're going to see when I show you the illustrations, they're coming up soon. We're almost done with this.
Benefit to reduce the fees. And they did add that surrender value endorsement that waives surrender charges and adds fees. And here's the rub. Here's where this policy really just falls on its face. When this policy was written, it had a cap around 11, 12% on a year-by-year basis. Today, the in-force ledger, the cap has been absolutely decimated. Now, the cap on the one-year S&P is 6.25%. 6.25% in a one-year cap. There are fixed accounts right now that are paying 5.5%. The maximum cap on your S&P is 6.25%. It was sold around 12%. How can that be? Now, some people are going to say this is exactly why you shouldn't buy an index life policy. And I can understand why they would say that, because it seems like this is totally out of your control. They just have total control over what happens to your caps, and that is true. However, everything in this policy was done wrong. Everything was done wrong. When you choose a surrender value agreement, when you choose a cash value accumulation test, all of these things silo you into like a policy segment. Every little choice that you make separates you from the pack. And so what these companies can do when they set their caps, they can say, all right, I want to see every single policy that has a surrender value agreement, a surrender value rider on there. And we're going to decrease those caps. If you don't have one, we won't decrease your cap. But if you do, we will. They can do that. They can look at every policy and they can say, we want to look at all the policies that have this cash value accumulation test. A lot of those are the high early cash value policies. And we want to decrease the caps on every policy that has the CVAT DEFRA type. They can do that. They can go in there and they can change your caps and your fees based on what you've done to the policy, based on the policy design. And so this is why I just had to.
He really made a point about that cap getting lowered. And he's trying to connect the dots and basically say that the insurance company chose to reduce the caps on that product because they used the cash value accumulation test or some other reason that put them into a certain class. Because remember, based on all kinds of things, they can make changes. The caps to the participation rates, and any changes they make will apply to insureds in the same class. Do you think the insurance company is just going to look at that policy and say, let's find the worst designed policies and go make changes to those? Let's go reduce all the caps on the people that bought the worst designed policies. Does that sound like a good business decision from an insurance company? Is he arguing that if you paid a higher base amount for insurance, that insurance company would not have reduced those cap rates from 12 to 6? I don't think that's what he's saying, but that's kind of the impression that you might get if you're watching this. It might be he's just trying to put the fear of God in you that the insurance company can make all kinds of changes, but you have no control over that. But I will tell you this, insurance companies don't generally make changes unless they need to. They don't want you to have a policy that performs badly. If you have a policy that performs badly, you probably stop sending them money, and they don't want that. They want you to be paying for insurance. That's how they make their money. So they're not just going to change these things on a whim, and you're not going to avoid a cap decrease because you chose a higher commission design from the insurance agent.
To make this video, I've seen 3 or 4 of these policies in the last couple of weeks. It is crucially important that you are working with someone that understands the pushes and pulls of these products. If you come to me and you say, Matt, I want high early cash value. I've heard about this CVAT thing where I can get more cash early. I heard about these waiver of surrender charges where I can get more cash early. That's what I want. My job is to say, hey, that's great. Understand, I hear you. Let me tell you all the reasons why that could go wrong. If you're not getting that side of the conversation, I totally understand why you would think, oh man, this is a scam. They just dropped my cap to 6 1/4. If you came to me, I'd say, I don't think you want to do that. I really don't think you want to do that. I understand that you want high early cash value, and if you want it, you can have it, but you are setting yourself up to have a policy that is on, high on the list of policies to be adjusted or experience fee increases or experience cap decreases. And the flip side is there's a way to build these policies to where you don't put yourself at risk of experiencing a fee increase or a cap decrease, for no other reason other than, you were trying to kind of beat the system, game the system. There's no such thing as a free lunch. So here's what I'm going to submit to you. If you are considering cash value life insurance,
again, he tied in the potential for high early cash value with a surrender value enhancement rider. He tied that in with the insurance company targeting you for reduced caps, reduced participation rates, other charges, just on a whim, that they're going to go after you. I do think it's important. I agree that it's important that you talk to an agent who understands these things. Now, the takeaway from this video is that he's the one to do it. He's going to steer you straight. This is that influencer effect. It sounds pretty good. He's got you sufficiently scared about making a misstep. I'm still waiting for the alternative design. Where's it at?
High early cash value reason. You need early cash as much as possible. You're talking to people and they're showing you waiver of surrender charge options. They're showing you, different little designs that get you more cash early. I'm just going to tell you, you need to be making sure that they're giving you the pros and cons of pursuing a high early cash value policy, because there is no such thing as a free lunch.
Okay, he's pushing it again hard. High early cash value. Remember, the reason we like high early cash value is because if it's properly designed, we're not paying extra for the liquidity rider, but we're going to have a lot lower expenses and a lot more cash later on in the policy. There's another reason why high early cash value can be considered important. What happens if things change and you have a financial emergency and you have to cancel your policy? If you don't have high early cash value, you're out tens of thousands of dollars. And in this particular scenario, it could be a lot more than that. I'm going to show you in the examples coming up. So there's a legitimate reason why high early cash value can actually be important. And it's not just something that people think sounds good. There's a legitimate reason for it financially. Sometimes people make a large commitment and then encounter a financial emergency that totally upends everything that they were planning. It might be worth it to have that high early cash value, even if it adds a little bit of risk at the beginning. Sometimes, even if it adds a little bit of expense. It's not very often that I add that enhanced liquidity rider. In fact, I think I've only done it once, because generally with the high cash value designs that we do it by reducing the expenses. And we get plenty of cash value in there, and we don't have to add an enhanced liquidity rider. The surrender charges are already reduced to a tiny amount. There's no reason to pay to get rid of them. But that comes from a proper design. Let's finish this.
I know that. Everybody knows that. But for whatever reason, when we start to see these ledgers, we see this ledger and it just looks so good. We see this ledger and this is exactly what I want. 200 in, I got 190 right away. I'm breaking even in year 3. This is exactly what I want. High early cash value in a tax preferential vehicle. Sign me up. But when you don't get the full context and you just see the illustration, but you don't know what can go wrong, I'm just telling you, you're setting yourselves up to be disappointed. You are being overpromised. And more often than not, those policies are going to under-deliver, because there is no such thing as a free lunch. So if you're considering this, I would encourage.
So there may not be such thing as a free lunch, but there's definitely such thing as a collaboration with your insurance agent to reduce the expenses so that that lunch costs a whole heck of a lot less. That's basically the end of his video. Let's take a look at some illustrations where I recreate this and we show you how you can do better. Let's start with this one. This is the recreation with the new product where we try and match the original design that he did. Notice the little mech symbol. I put a thing up in the corner there that tells you what design we're looking at. This is the mech design. The mech design matches the one that he showed in the video to the best of our ability. There are some different charges with this product than in that one. But look at this, 190 cash value in the first year. So we're very close. 2.5 million death benefit to start, putting in 200,000 a year, we got $1 million. Here's the policy charges ledger for that. We're a little lower on the per unit charge. We only have that cost of insurance for 1 year, and then we have our rider charges column. Now take a look at the rider charges. They kind of go up a little bit each year until we make a change in this year. And then right here between years 12 and 13, that's when that enhancement rider falls off. And so the expenses go down because there's no longer that enhancement rider that does away with the surrender charges. But we've got the per unit charge. Now the new product has lower load fees than the old product. And they don't charge extra anymore if you go above the mech limit. So if you created a mech, you're not paying any more. It's a 9% load fee the first year, 5% after that. In that old product, it was 8% for 9 years, and then 4% after that. So that's what you're looking at here from a premium charge. This per unit charge. The per unit charge, I talked about this a little bit earlier. This is where they're going to recoup all of the expenses it took to sell you the policy, including the commissions. The commissions are the biggest impact on this, but this number is determined by the target premium. And in a lot of policies, you're going to find that target premium listed somewhere in the illustration. Not everyone, and there are some products where an agent can suppress it, but you should look for it. In this case, the target premium is $6,600. Remember, that is our recreation here. A good rule of thumb is to assume an agent generally makes 100% of target premium for the first year's commission. So with this particular design, that would be a little over $6,000 for that first year's commission. Now, if you're putting in more money, there's a little bit extra that gets paid above that target premium, but it's a very small amount. So that's why I say that's just a good general rule of thumb. And when we think about target premium, in general, the lower the better, as long as the rest of the policy does what you need it to do. Now, we've got the rider charges. This includes our cost of insurance, and it includes for the enhanced liquidity rider. That does away with the surrender charge, at least for a while. Now, remember I talked about the guarantee ledger. The guarantee ledger tells you the maximum charges. Now, that policy that he showed you in that video was meant to evoke fear, uncertainty, and doubt. I'm surprised he didn't show the guaranteed ledger on that, because if he did, most likely what you're going to see is massive insurance charges, because the guaranteed ledger assumes no growth in the index ever and maximum charges. You can see here in the first year, they didn't get any growth in the index. So instead of 190,000 available at the end of the year, you only have 171. And down here, where we're no longer putting in money and we don't have that load fee to worry about, and our policy charge, we're paying $9,000. Well, that's based on the death benefit at risk to the insurance company, which is the difference between these two numbers. So you're essentially paying the maximum cost of insurance for $1.65 million. All right, that's expensive, but that's the most. In this scenario, that's the most. $9,000. Let's remember that, $9,000. And then down here, when we get past year 15, when we're no longer paying to recoup the cost of the commissions and the other costs to sell you the policy, we're paying for about $1.75 million in death benefit, and the cost is $13,000. This is only the cost of insurance at this point. Age 61. Let's go to the policy charges ledger. At age 61, under the current expense cost, that cost of insurance would only be $4,500 instead of $13,000. Now, that $13,000 was for $1.7 million. If we look at this ledger, here it is at 61, you can see $4,600, and we're only paying for $1.3 million in death benefit. So it's not quite apples to apples, but it looks like it might be maybe twice as expensive. In the worst case scenario, it might cost you twice as much, maybe 3 times, somewhere between 2 and 3 times as much in this scenario with this product. Now that doesn't sound good. The insurance company is going to triple the cost of your insurance. Nobody's going to like that, but they don't generally just do that on a whim. And let's think about the alternative. Before I show you the alternative, this is our mech design number 2. I made this illustration because when we see the basic guaranteed scenario, that cash value does not grow quick enough to reduce the amount of death benefit. So you're paying for a whole lot of death benefit. When in reality, one of the ways to manage the expenses in a policy is when you stop funding it, you reduce the death benefit. So I made sure to do that in this one so we could see in a worst case scenario, what is the actual cost of that insurance? If they're charging us the most that they can charge us for that supplemental term, take a look at this. If we only had 800,000 in there because the index never returned anything, we got zeros the whole time, we don't have to pay for 1.7 million in death benefit. You can see here, we're only paying for a little over 400,000 and the cost, 4,900. Suddenly, this is not so expensive. In the worst case scenario, they're charging you the maximum amount that they can charge you for that supplemental term, and it's less than $5,000 at age 61. And you've got 800 grand inside this policy. Now, the reality is it'll probably perform somewhere around the non-guaranteed scenario, depending on how conservative your agent illustrated. And in this case, at age 61, we do have a significant amount of cash value in here, 2.295 million. Now, I put in here an assumption of 6% average return. If you built up at a 6% average return until age 61, you have to pay for 1.2 million in death benefit. And if the insurance company decided to jack up your rates at that 1.2 million, yeah, you're going to be around $13,000 for the year. But in context, you got $2.3 million in that policy. So it's not that big of a deal. It's not the big deal that he's making it out to be in that video. Fear, uncertainty, and doubt. Don't worry about it. Before I show you what the best designs look like, just know that if the insurance company ever jacks up your rates and you don't want to pay for that, you have alternatives. There are mitigating actions that you can take. You can reduce the amount of death benefit that you're paying for. You can do a 1035 exchange and move into a new product. You can surrender your current product, just take your cash and walk away. You don't have to just pay a high cost of insurance. That's why the insurance companies don't just jack up your costs for no reason, because you could just go somewhere else. All right, let's compare this to the best design. Actually, before we go to the best design, I've got to go over the bad design. And the bad design is how he described that he would design the policy, except he did mention that he would do some blend. But I've seen a number of illustrations come from their company that does no blend. So this is what I designed. A design that doesn't use the cash value accumulation test. It doesn't create a mech. It requires more death benefit in order to get in the same amount of money. This is using the guideline premium for the mech test, which is what you would actually want to do. And you're going to see why when we get to the good design. But here on the bad design, you have to pay for more death benefit to do it. Normally, if it's a good design, not that big of a deal to pay for the extra death benefit because we're blending in the non-commissionable term. But in this case, it really increases the commission and you have massive surrender charges that impacts your access to the cash value in case of a financial emergency. Look at the cash value here. The actual value in the policy, 172 in that first year. That's at the end of the year after you get some growth. Whereas in the supposed bad policy that he was showing, you got 190,000. Now you paid a little extra for that, but you got 18,000 more actual dollars than if you did an all-base design, no blend. I mean, as risky as he makes it sound, why would you do any blend, right? But the surrender charges, you've got a $122,000 surrender charge. Why would they need to have that big of a surrender charge? It's because of that target premium. $76,000 commission would get paid out on this policy. Do you remember what it was on the other design? $6,000. That's a massive difference, folks. Massive difference. Let's look at that policy charges ledger and see what's going on. Oh, this looks the same. This looks the same. Oh boy, per unit charge. That's a lot higher. That's a heck of a lot higher. And the cost of insurance, that looks a lot higher too. What was it in the other design? $1,600 for that per unit charge. And the total cost of insurance, when you add it up between these two, about $2,800. About our total expenses at year 15, when we're done paying back the commissions, $139,000. When we do the blended design and we add the enhanced liquidity rider and it's a mech, and it's a cash value accumulation test, all the bad things. And the alternative one that he suggests, that same time period, we're at $346,000 in expenses. We're at $221 just in the recouping of the commission. Now, he did say he does do some blending in here, but how much? If he reduces the commission by half, if he blends half of the supplemental term, you're still over $100,000 just in the recouping of the commissions. Not to mention the cost of the insurance that's going to be over here. What about what that does to the cash value? You don't need that early cash value, in his opinion, because it hurts you. It's too risky. With the cash value assumption, let's go age 61 again. 1.9 million on the bad design that doesn't blend any supplemental term insurance, compared to 2.3. This is $400,000 extra on the mech design. Now, this is a mech. You don't want a mech policy. So let's look at what an actual good design looks like. Let's look at these policy charges. We have the same premium charge. We have the same policy fee. We have a nice low per unit charge. That stays the same for 15 years. We have our cost of insurance, lasts for a few years and then goes away in the insurance column. This is going to happen at year 7. After year 7, when we're no longer putting any money in, we're going to switch from an increasing death benefit to a level death benefit, and we're going to reduce the amount of death benefit. We see that cost of insurance go way down. This is the expected low expense of insurance when we use the supplemental term rider with this product. Look at these expenses at year 15. Total expenses $140,000. Again, that bad design $346,000, and the mech design $139,000. Now the mech design is actually lower expenses than my best design. But remember, we have to pay for more insurance in those early years with the design that I did because we're using the guideline premium test. It makes up for it later on in the policy. Let's check our total expenses a bit later on in the policy. Here, by the time we get to age 90, we've got 1.134 million in total expenses, with a large part of those coming within the last 5 years. You could see 5 years earlier, we were only at 716,000. That's because of the extra insurance that he mentioned that you have to pay for when you use the cash value accumulation test. It's not because it was a mech, it's because it used the cash value accumulation test, and you have to pay for more insurance. It makes the biggest impact late in the policy when you're old and that cost of annual renewable term insurance is high. 1.13, and with the best design that I do, this is going to blow your mind. 557,000 in total expenses. That's $600,000 less than that cash value accumulation test design. This is why we do the designs that we do. You can see even most of those expenses came in the last 5 years. We went from 338 to 557. Now, most people don't live this long, but even if you do, we're not going to be paying $500,000 in cost of insurance over those 5 years like we would with that other design. And realistically, in this scenario, if you get that 6% average rate of return and you make it to age 90, you got $15 million in there. So our expenses as a percentage of the cash value are very, very low. This is a really good example back here at 61 with this best design. If they keep the current cost of the insurance, $2,500 at age 61. What's the worst case scenario? Maybe triple that? If we've made 6% average return all the way up until here, and then they decided to jack up our rates to the maximum amount. We might have $6,000 expense, but we got $2 million in here. I think you'll be okay. What is the trade-off here? Let's say they jack up that cost of insurance later on in the policy. You could end up, if you keep it, you could end up paying tens of thousands of dollars more later on in the policy. But you know what happens when you don't do a good design? You're guaranteed to pay tens of thousands of more, hundreds of thousands of more potentially. You're guaranteed if you go with that higher base design. So this is the crux of my argument and why I say this is the definitive guide to how to do a properly designed IUL. Do you want to guarantee yourself massive savings early on by blending in some supplemental insurance? Those savings allow growth and compounding for who knows how long before the insurance company might potentially, maybe raise the cost of insurance inside your policy. And maybe that will cost you $10,000 more, $20,000, $100,000 later on in life if they jack those rates up and you decide to keep the policy. We've got guaranteed savings up front with a proper design, not just on the per unit charge, but our cost of insurance was actually lower as well. when we did the blended design. There's all kinds of savings to be had when we properly design this. If you want to see what I can do for you, schedule a meeting with me, use my Calendly link, we meet via Zoom, I'll share my screen, I show you exactly how we do the design that's tailored to meet your needs. We can talk about the risk. We can look at what the actual savings will be. If you have an illustration from a different agent, let's see if I can do it better. We'll talk about those risks. What is the potential risk compared to the actual savings that my design will do? I love having those conversations. And I've got a lot of happy clients that know that they saved a lot of money and they got the best design possible. You could be next. I hope to see you soon. Oh my goodness, I nearly forgot to show you the early years of the best design. We don't have to use the enhanced liquidity rider. Look at this. We have almost $190,000 in accumulated value, and our surrender charge is only $11,000. You still have access to most of the cash that you paid into it. Now, these are end of year numbers. You're not going to have that right after you sign up for the policy, but the bulk of that cash is going to be available. And when we have the bulk of it available like this, we don't need to add the enhanced liquidity rider. Why add an extra expense just to get access to just a few more dollars? Is access to that $11,000 going to make or break your budget? Are you going to miss out on some monster investment deal because you didn't have access to that? Probably not. I would say for most people not. That's why I never include it. It's just not worth adding that extra expense. And you know, according to Matt, it might keep you out of the doghouse with the insurance company, and maybe they'll keep your cap rates high because you didn't add the enhanced liquidity rider. If you have any questions, you can leave them in the comment section below. I'm always happy to answer them. And if you want to follow along on this journey, as we put out more videos to help educate you, hit that subscribe button and ding the notification bell. Happy to have you join us on this. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.